Welcome back. Excel is a most commonly used tool for data analysis and building financial models for efficient decision making. It is used by people with diverse backgrounds like bankers, analysts, professionals, and students. In Excel, there are a lot of inbuilt functions which can be used for quick data analysis. In this video, we will cover 10 such financial functions which we can use for a quick data analysis in Excel. So, watch this video till the end and like and share this video if you find it useful. NPV or net present value is the present value of cash inflows minus present value of cash outflows. It is used for capital budgeting and investment decisions. The decision could be for an investment in a replacement of a fixed asset, investment or acquisition of a company, or investment in a capital intensive project. Excel has an inbuilt NPV calculation formula which calculates the net present value of a series of cash flows at a given discount rate. Negative cash flows are considered as cash outflows, while positive cash flows are considered as cash inflows. Let's look at an example. We are considering the financial viability of an investment. The cash flows of the investment are as follows. During the start of the project, you have to make an investment of $100,000 and then you get positive cash flows from year 1 onwards. The discount rate or cost of capital for financing this project is 10%. To calculate NPV, type is equal to NPV, then rate is 10%, so we link it to cell D11, and then it asks for values, which is the cash inflows and outflows from the project. While calculating NPV, we will select the cash flows from year 1 because in Excel, the NPV calculation formula considers cash flows to occur at the end of each period. So we are making the investment during start of the period, so we will ignore this in the NPV calculation formula. So select the cash inflows of this project in this example and then add the initial cash investment separately because it occurs during the start of the period or start of the project. Press enter. So you get an NPV of 25,185, which is a positive number. When NPV is positive, the investment project should be accepted because it is value creating. If the value of NPV is a negative number, then we should not accept that project because it is not financially viable. Moving to the next function, XNPV. XNPV is extended NPV. It measures the NPV of a stream of scheduled cash flows. It is an advanced version of the NPV function. The difference between NPV and XNPV is that in NPV function, as discussed, Excel considers the cash flows to occur at the end of each period, whereas in XNPV, the cash flows occur at dates defined in the model. So to calculate the XNPV, type is equal to XNPV. It asks for rate, which is the discount rate or the cost of capital. Then it asks for values. So in XNPV, we have to select the entire stream of cash flows, including the initial cash investment. And then it asks for the dates. If the cash flows are occurring at different time periods and we have the dates of the cash flows, so we should use the XNPV to calculate the exact value creation from the project. Close the bracket and then enter. You get an XNPV of 21 to 47. It is again a positive number, so the project can be accepted. There are a few important points which we should remember while using the XNPV function. So the first important point is that XNPV does not discount the initial cash flows. This is the difference versus the NPV function. The dates we have should be in Excel valid format. So if we don't have the valid date format, then this formula or this function will not work. The range of the values and the dates should be in sync. If the dates and the values are not in sync, then Excel will give an incorrect calculation. We have to ensure that the range for dates and values are in sync with each other. That's it for XNPV. Moving to the third function, which is the IRR. IRR is the internal rate of return for a series of cash flows. Internal rate of return is the rate at which present value of cash inflows is equal to the present value of cash outflows. So this is the rate at which NPV of cash flows is 0. IRR is also used to analyze potential investment decisions. If the IRR of a project is greater than cost of capital, then the project should be accepted. If IRR is less than cost of capital, then the project shouldn't be accepted because it is value destroying. Let us look at an example. So we are considering the financial viability of an investment. The cash flows are as follows. During the start of the project, we have to make an investment of $100,000 and then we get positive cash flows starting end of year 1. To calculate IRR, we will type is equal to IRR. Then the values, so we'll select the entire series of values and then we have to give a guess. Guess is a guesstimate number of the IRR which we consider should be the IRR of the project. It is optional to give the guess because it is in square brackets. So we can just select the stream of cash flows, close the bracket and press enter. We get an IRR of 18.37% for this project. So this project should be accepted because the internal rate of return or the IRR is greater than the cost of capital, which is 10%. We discussed that IRR is the rate at which NPV of a project should be 0 or NPV of a project is 0. So if we want to test this, we can calculate the NPV using 18.37% as the discount rate. So we type is equal to NPV, the rate, the values, close bracket, and then add the cash outflows at start of the project, press enter, and we get an NPV of 0, meaning that at 18.37%, the net present value of this investment is 0. Like the XNPV function, there is an XIRR function in Excel, which is an extended version of internal rate of return. It is used to calculate the internal rate of return of a stream of cash flows occurring during different time periods. It is commonly used while analyzing returns on investment made during different time periods. Let's look at an example. So the example here shows the investments made in a mutual fund during different time periods. So the minus values or the negative values are the investments made. The positive value, the cash inflow on redemption of the investment. To calculate XIRR, type is equal to XIRR. The values, select the entire stream of values, comma, the dates, close the bracket and then enter. So it shows the XIRR, or the rate of return on investment, is 16.5%. A couple of points to keep in mind while using the XIRR example. The dates used should be in Excel defined format. So if we are using dates which are not recognized by Excel, then this formula or function will not work. And the second point to keep in mind is the range of the values and the dates should be in sync, like we discussed in the XNPV example. Moving to the next function, MIRR. MIRR is a modified version of internal rate of return. It is known as modified internal rate of return. In IRR, there is an inbuilt assumption that the cash inflows occurring during the project are reinvested at the internal rate of return. So if the internal rate of return of a project is 40%, it is assumed that the cash inflows arrived from the project are reinvested at 40%. So this assumption may not hold true in many situations because there may not be such opportunities to invest at 40%. In modified IRR or MIRR, we have the option to put the cost of capital or the discount rate and the reinvestment rate. So this function solves some of the problems or limitations with the IRR function. To calculate MIRR, type is equal to MIRR bracket open values. So we have the values. So select the entire series of values, comma, the finance rate. The finance rate is the cost of capital, and the reinvestment rate, the rate which you assume to get by reinvesting the cash inflows from the project. So close the bracket and then enter. So this shows that the MIRR of the project is 17%. From decision making perspective, the MIRR is greater than cost of capital and hence the project can be accepted. PMT, or the payment function, helps calculate the loan EMIs. This function is mostly used to calculate the periodic payments of the EMIs for financing a project. To calculate the PMT, type is equal to PMT. It asks for rate, which is the rate of interest on the loan amount. So select the rate and then divide it by 12 because we want to calculate the monthly installments. NPER is the number of installments or the loan tenure. So here we have 10 years. So we select 10 years, then multiply by 12, which is 120 months. Present value is the amount of the loan. The future value is the value we expect at the end of the loan tenure. So here we expect the future value of the loan to be 0 because it will be paid entirely. The fifth input is type, which is a value we should enter to define the time of the EMIs. So if we enter 1, it means that the EMIs are paid at the beginning of the period. And if we enter 0, it means that EMIs are paid at the end of the period. In case we don't fill type, Excel assumes that EMIs are paid at the end of the period. So here the EMIs will be paid at the end of the period. So we don't fill it and then press enter. So we get a PMT of 1161. So this means that for taking a loan of $100,000 at 7% interest and with a loan tenure of 10 years, we have to pay an EMI of $1,161 for 120 months to repay the loan. NPER is generally used to calculate the tenure of the loan EMI. If the interest rate principal amount, outstanding balance at the end of the period, and monthly payment is known. So in this example, we have a loan of $100,000. The interest rate is 7% and the EMI is $1,000. So we want to calculate the loan tenure. To calculate the loan tenure, type is equal to NPER, bracket open, rate which is 7% divided by 12, comma, PMT is the amount of installment which is $1,000. It is negative because it's a cash outflow. Present value is the amount of loan. Future value is 0 and type again is 0 because it happens at the end of the period. Enter. We get 150. This is 150 months. If we divide it by 12, we get the loan tenure of 12.5 years. This means that for a loan amount of $100,000 at 7% interest rate, $1,000 EMI has to be paid for 12.5 years to repay the loan fully. Rate function calculates the rate of the interest on the loan or investment. In this example, we have a loan of $100,000. Monthly installment is $1,161 for 10 years. So we are required to calculate the rate of interest. To calculate rate, type is equal to rate, NPER, which is the loan tenure. So multiply it by 12. Then PMT is the payment, $1,161. Present value of the loan, 100,000. Future value is 0. And then type is 0 because EMIs are paid at the end of the period. Let's enter. We get 0.58. So this is the monthly interest rate. If we multiply it by 12, we get the annual interest rate, which is 7%. PPMT function returns the principal payment for a given loan based on periodic constant payments and constant interest rate. So this function calculates the principal payment made in a particular EMI. In this example, we have a loan amount of $100,000. The interest rate is 7%. Tenure is 3 years. The loan EMI is paid annually, which is $38,105. We want to calculate what is the principal amount paid in each year. To calculate the PPMT function, type is equal to PPMT. Rate is the rate of interest. Per is the period for which we are paying the EMI. So in year 1, we have to enter 1. So select year 1. NPER is the tenure of the loan, which is 3 years. Present value, $100,000. Future value is 0. And type is 0. Enter. So we get 31,105. This means that out of 38,105, which is the total EMI, 31,105 is the principal payment. So we'll fix this formula by pressing F4. F4, C11 will change because if we want to calculate for year 2 and 3, it has to move to those cells. And the remaining D6, D4 and D7 we can lock by pressing F4. Enter. Now we copy this formula by pressing Ctrl C and then paste it by pressing Ctrl V. So we have calculated the principal repayment in year 2 and 3. So principal repayment increases periodically. So in this example, it increases from $31,105 to $33,282 in year 2 and $35,612 in year 3. If we sum up all three, we get total of $100,000, which is the total of the loan amount. The IPMT function calculates the interest payment for a given loan based on constant periodic payments and constant interest rates. So taking the previous example where we had a loan of $100,000 to be repaid in 3 years, interest rate of 7%, and the EMI amount of 38,105. So we calculated the principal payment. If we want to calculate the interest payment as well, we'll use the IPMT function. To calculate the IPMT, type is equal to IPMT, the rate of the loan, the period, loan tenure, present value, future value, and type, enter. So we get 7,000. That means in year 1, out of the total EMI, 7,000 is the interest amount. If we add up the principal and the interest amount, we get an EMI of 38,105. Now, if we want to copy and paste this formula to other cells, we need to freeze the cells. So we'll press F4 to lock the cells and then press Ctrl C and Ctrl V to paste this formula. So we see as the loan tenure increases, the principal payment increases while the interest payment decreases. Hope you enjoyed this session. Thank you.